right. Good morning, everybody. Today is Monday, July 3rd, 2023. We got a short trading day today. I hope you guys are well. A new week is upon us. I'm back at Melonhead HQ after my vacation. I hope you guys are well. A lot going on this morning. Everybody's talking about Tesla. Oh my God, Tesla beat Delivery. They made so many cars. I'm not so interested in how many cars Tesla delivered. When it comes to the car market, I'm interested in another article that I saw that said the auto market is less affordable now than at any point in history. Between the price of a new car and between interest rates being charged on new cars, nobody can afford a new car. And oh, guess what? Student loan payments are coming back. We got that little gem over the weekend, or at least on Friday. The Supreme Court has struck down student loan forgiveness. And so starting in August, 1 in 10 adults has a $400 a month average student loan payment coming back. And what do you think that's going to do to the auto market? What do you think that's going to do to the rental market? You see, while all these folks have been struggling with the cost of increased rent and increased auto payments, their student loans were on hold. And so a lot of those price increases had been offset by the student loan payments. Now, most people didn't even realize that was happening, but they're going to realize real fast just as soon as those payments come back. And I suspect that the auto market will be up front, the first one to suffer from student loan payments coming back. Elsewhere, we've got oil production cuts again this morning. Saudi Arabia and Russia both announcing that they are extending previously announced cuts into August and through August. So there's another 1.5 million barrels per day of oil through the summer that will not be hitting the market. This is an extension of cuts that so far have really failed to support higher oil prices. They've stemmed the decline somewhat. Oil remains in this range, high 60s to low 70s, that it's been in since the start of the year, when the China reopening story has failed to drive higher oil prices. And speaking of China, bad news coming out of the China property market once again. New home sales for the top 100 developers in China were down 28% year over year in the latest reading. That's after a couple of months of actually seeing some decent price growth, some decent growth in the amount of homes being sold by these top 100 developers. Well, it looks like that was a very short-lived recovery, dare I say a dead cat bounce. And now it looks like prices are heading south again. A bad sign for the China housing bubble, which, if you've been following this channel since 2021, I would argue is the biggest bubble in history. And with that, I have to say thank you so much to the sponsor of today's live stream, the Patriot Gold Group. You know, guys, we're talking about car bubbles, property bubbles, student loan payments coming back, financial mayhem. Nobody really knows where this is going. Nobody really knows how long until the Fed goes burr again, but ask just about anybody and they'll tell you eventually Fed is going to go burr once again. It's just a matter of how much pain they're going to inflict on us between now and then. And when that happens, the best way to protect yourself is through the ownership of physical precious metals like gold and silver. And that's why I am happy to endorse the Patriot Gold Group. They're a top-rated gold and silver-backed IRA dealer for several years in a row by Consumer Affairs. So visit nsfgold.com. There's a link down below in the description, or call 888-988-5401. And, of course, tell them that nobody sent you. And with that, let's shrink my big melon and see what's going on in the world of stocks and bonds this morning. We've got the S&P is down just barely 3 points, or 0.08%, at 4,446. We got the Dow is down a little bit more than that, 88 points, or a quarter of 1%, trading at 34,319. And we got the NASDAQ is in green territory, up 25 points, or 0.2%, trading at 13,800. So the market is a little bit risk on this morning, just a little bit. Looks like the U.S. dollar is flat but headed lower, currently at 102.97. It was up earlier in the day, currently up 6 basis points. And looking over at bonds, we've got yields are still creeping higher across most of the curve. The 10-year is up about 1 basis point, yielding 3.82. The 2-year up 3 bips, yielding 4.9, and the 1 month at 5.2. So bond yields going a little bit higher as Janet Yellen continues to suck liquidity out of the bond market. And speaking of liquidity in the bond market, check out the reverse repo. Remember that big quarter end spike that we're supposed to get at the end of every quarter? Kind of like this big one that we saw at the end of December last year, where we had that big jump at the end of the year in reverse repos. You usually get that at the end of the quarter. Well, this quarter, that end of quarter spike was pretty pathetic. We went from 1.934 trillion to just over 2 trillion. So we did get that quarter end spike that I was calling for. No surprise there, but it was pretty small, and I suspect reverse repos are going to start resuming their decline, which has been pretty rapid since the debt ceiling was passed. That means Janet Yellen borrowing all that money to refill the Treasury General account. That is coming out of the reverse repos. That is all the spare liquidity the bond market has, and when that dries up, look out below. But here is the commodity story for today. We have got gold is up $1.25 at 1,930. Silver is having a good morning, up about 11 cents or 0.5% at 23.12. WTI crude, flat. Really, it's up 9 cents or 0.13%, trading at $70.73. Kind of shrugging off that production cut or the extension of the production cuts by OPEC+. Again, oil prices are just yawning at all of these production cuts. And here is the story in question. Saudis and Russia extend oil supply cuts, bolstering prices. Brent crude prices had jumped to over $76 a barrel in London. The kingdom extends extra voluntary cut of 1 million barrels per day in August. Saudi Arabia will prolong its unilateral oil production cut by 1 month, keeping a lid on supply amid persisting fears over the global economy. Its OPEC Plus ally, Russia, also announced fresh curbs on exports. The kingdom will maintain the 1 million barrel per day reduction launched this month on top of existing curbs agreed with OPEC Plus. That's into August and could extend it further, according to a statement published by state-run Saudi press agency. The country will pump about 9 million barrels per day. That's the lowest in several years, sacrificing sales volume for what has so far been a minimal reward in terms of higher prices. The Saudi effort will be assisted by Russia, which will reduce oil exports by 500,000 barrels per day. In August, Deputy Prime Minister Alexander Novak said in comments published by his press service, he later added that the country will also aim to reduce production by this amount. And it's not just Saudi and Russia production you need to worry about. Check out the Baker Hughes crude oil rig count. Now, this data was released on Friday afternoon, but the U.S. lost another oil rig last week. And you can see, going all the way back to April, we were just under 600 operating oil rigs in the U.S. We are now down to 545. So U.S. oil production, the number of rigs producing oil in the U.S. is in decline, even as the Russians and the Saudis restrict supply. So the oil market is starting to become a little bit illiquid, folks. Keep an eye on that. Now, so far, the story of the global recession has been dominating the oil narrative, sending prices lower or at least holding them lower. But as the production cuts pile up and as U.S. production weakens, we could see that narrative start to flip to become an illiquid, tight supply, which would drive prices higher. Although for now, we're still sitting down here. We've got this floor just below $67 a barrel that has held 1, 2, 3, 4, 5 times now. We keep bouncing at this level. And despite all of these production cuts announced by the Saudis, they've really failed to send oil any higher than $74, $75 a barrel right now. So oil remains range-bound. And elsewhere, this is the story everybody's talking about this morning. You go to Bloomberg, you go to Wall Street Journal, CNBC, any of them. They're all saying, oh my God, Tesla made so many cars. Tesla delivers 466,140 vehicles worldwide, beating estimates. And BYD, their Chinese counterpart, they sold 700,000 cars. EVs are taking over the world. This is the biggest story in finance right now. I'm not so excited about this story, guys. And I'll tell you why I'm not excited, because of this story right here. With just 8% of new vehicles costing under $30,000, it's the least affordable car market in modern history, experts say. Just 8% of vehicles cost less than $30,000. That's amazing. The average person just cannot afford a new car. Pretty soon, the average person can't afford a used car. So I'm less excited about all these cars Tesla is delivering, and I'm more worried about the fact that people are not going to be able to afford those cars very soon, and so they're just going to be sitting on the lots. And keep in mind, student loan payments are coming back in August, $400 a month for 1 in 10 adults. Those 1 in 10 adults are not going to be able to afford a Tesla. Today, new cars under $30,000 make up just 8% of the market supply, down from 38% pre-pandemic. With fully loaded SUVs and trucks in high demand, car makers continue to upgrade their lineups and scale back less expensive cars. By nearly every measure, buying a car has become extremely expensive. Not only are new vehicle prices near all-time highs, but the interest rate to finance a purchase has also jumped dramatically. Now, fewer affordable new cars even hit the market, according to recent reports. Today, new cars priced under $30,000 make up just 8% of the market supply, down from 38% pre-pandemic, according to car shopping app Copilot. Just 3 years ago, guys, 3 years ago, 38% of cars were under $30,000. Now it is 8%. Car prices have just exploded, and they're saying it's the least affordable car market in modern history, according to Copilot CEO Pat Ryan. So watch out, guys, with student loans coming back. This is the market that is going to see that hit first. Also, keep an eye on that auto financing, because that has been a big deal lately, with a lot of banks and a lot of lenders restricting their loans into the auto space, worried about defaults and rising repossessions. It's another thing to keep an eye on. And also keep an eye on this story. China home sales by the top developers plunge in warning sign. It's been a while since we heard about the China property market on this channel, but China home sales tumbled in June, snapping a 4-month rebound, suggesting the country's vast property market is far from stabilizing. The value of new home sales by the 100 biggest real estate developers fell by 28% to 526 billion yuan. That's from a year earlier, according to preliminary data from the Chinese Real Estate Information Corp. That compares with a gain of 6.7% in the previous month. Sales gained 8.5% month over month. So it's important to point out an 8.5% gain month over month. So it's still trending upward. It's the year over year number that's down, but the year over year number is down big, 28%. A faltering housing market poses a risk to the economy, which is already under strain from weak consumer spending. Signs of weakness are emerging in the residential market after sales and prices rebounded briefly following a historical slump of about 18 months. And that's not the only one. That story led to this one today. China Vanke says local home market is worse than expected. Now, China Vanke, that is the second largest developer in China behind Evergrande, or I believe Country Garden is the biggest. Evergrande is gone now. The Vanke chairman turns bearish on current property sector. China home sales snapped a 4-month rise, resuming declines. China's second largest developer by sales said the nation's home market is currently worse than expected, joining a chorus of investors and analysts who have become bearish on the country's real estate sector. So you've got the developers are starting to chime in here, folks, saying, yeah, things are not as good as we were hoping for. The reopening has fizzled out. That story is a dud. And with this report on Friday about home sales dropping 28% year over year, well, China is a real estate dependent economy. Almost 2/3 of China's economy is driven by construction or housing or some satellite industry that all centers around housing. And that industry has been in dire straits really since 2021. Now, they had a little bit of signs of life earlier this year. The reopening was going to save everything. It's going to revitalize the consumer. The home sales were going to come back. Yeah, not so much. So once again, the China reopening has failed to do anything to bolster the world economy. And with more oil production cuts coming, it looks like OPEC doesn't really see any silver lining to that big gray cloud over in the Chinese market. All right, guys, that's all I got for you today. Again, we have a short trading day today. Markets close at 1 p.m. and we are closed tomorrow for the 4th of July. Happy birthday, America. So there will be no live stream tomorrow. I will be back Wednesday morning, bright and early as usual. I want to say thank you so much to my Patreon supporters for everything you guys do for the channel. I really appreciate you guys. Thank you to Patriot Gold for sponsoring this live stream. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.